Right. Hello, my name is Matthew Hinkle. My presentation today is on WorldCom. We're going to start off with a brief company overview from their founding until where they stand today. Basically, the company was founded in 1983. They're founded from Mississippi, originally known as Long Distance Discount Services, or LDDS. They were put together by a couple guys in a coffee shop, basically drew up the plan on a napkin, and formed the company. In 1985, one of their early investors, Bernard Evers, they appointed him to CEO. His former jobs were a bar bouncer, a basketball coach, and a hotel owner. Not typical jobs of a CEO you see today. In 1989, the company went public. LDDS went public by acquiring Advantage Co. In 1995, they changed their name from LDDS to WorldCom. And one of the big events here in April of 1998, they bought MCI Communications for $37 billion. This led to the formation of MCI WorldCom. They later changed the name back to WorldCom, but for a while it was known as MCI WorldCom. And this was huge because this was the largest merger in U.S. history at this time. MCI was nearly twice as big as WorldCom. In 1999, WorldCom and Sprint agreed to a merger. This would have even surpassed the MCI Communications merger. And this led to WorldCom's peak market value at $181 billion, leaving their share price at approximately $64 per share. And this slide right here is basically the rise of WorldCom. It doesn't get any better for them after this, as we'll see in the next few slides. Starting in July, or in 2000 July, you remember that deal with Sprint and WorldCom? Well, the U.S. and European regulators blocked that, so WorldCom and Sprint had to terminate that. During 2000, this is the same time as the dot-com bubble burst. There was huge declines in all telecom stock values. And in 2002, around March, this is when the stuff really starts to hit the fan for them. WorldCom received a request from information on their accounting practices and loans to officers from the SEC. And then in 2002, this is when the big stuff happened. This is when the fraud was revealed originally. They originally revealed $3.8 billion with a B, in improperly counted expenses. They fired their CFO, Mr. Sullivan. Their trading was halted on the stock exchange. Right before the halt, their stock had dropped down to as low as 9 cents. And as you remember from the slide before, it was up at $64. So it went down big time. And also during the same month, the SEC filed civil charges against WorldCom. And not a month later in July, from the fraud being revealed and the SEC investigation, WorldCom had to file for Chapter 11 bankruptcy. And another record for WorldCom here is that this was the largest Chapter 11 bankruptcy at the time. Later through the investigation, they had to hire on new auditors. The original auditor was Arthur Anderson, I forgot to mention that, but they had KPMG come in after the bankruptcy and ended up discovering a ton of fraud. And in March 2003, they had to take a one-time write-off of $79.8 billion. In 2003, they decided to change their name to MCI and kind of shake the WorldCom status they had there. They also moved their headquarters from Clinton, Mississippi to Jules, Virginia. 2003, around August, the SEC investigation led to a $750 million fine on the investors' behalf that WorldCom had to pay. In 2004, the company finally emerged from bankruptcy almost 2 years later. And in 2005, Verizon bought out MCI for $6.75 billion, and that's where it resides now. It's a subsidiary of Verizon Communications. So this slide is talking about the accounting regularities, basically how they committed the fraud. It's pretty much as simplistic as you can get. They were capitalizing expenses instead of just straight writing them off as they should have. They were taking their line costs and capitalizing them, basically allowing them to depreciate them over periods of time instead of taking a direct write-off during that period, which is, as you can see at the bottom slide, required by GAAP. GAAP required them to expense the line costs in the period they incurred. Also, the other thing that they were doing is just blatantly increasing revenue that weren't attributed to operating results. So basically, this was cooking the books 101, led investors and myself to believe that this should have been caught by the auditors. It's pretty simplistic compared to what you saw in Enron and other major frauds at the time. The total fraudulent activities, these accounting irregularities, they totaled $11 billion, which was the largest fraud scandal of the time. It's even bigger than Enron, although you hear Enron associated with fraud, the big 2000 frauds a lot more often. And then here at the bottom of the slide, they also had loans to officers, which originally helped lead to the SEC investigation. Basically, the board of directors didn't want their CEO, Bernard Edwards, to sell his stock off to meet the margin calls when the dot-com bubble burst in 2000. So they gave him excessive loans, you see $408 million, just so he wouldn't have to sell his loans off and hope that the company would rebound. Unfortunately, it didn't. Here's the stock history timeline here. We're going to start with their peak. If you remember the summer of 1999 with the Sprint merger, the stock was at its high at $64, approximately $64.76. Then in January 2001, after the dot-com bubble burst, the stock had dropped drastically. It fell below $10 a share. And then in 2002, May, after the SEC asked for their investigation and everything like that, WorldCom had to scrap its dividend payments and got rid of 2 of its tracking stocks. And shortly after in that month was the huge fire sale that everyone talks about. The $670 million were traded on May 14, 2002. And once again, another world record at the time for WorldCom. And then in June 24th, this is when, about the same time, all the fraud and CFOs was getting fired. The analysts started bashing the stock, basically giving negative reports, listing it as junk status, and it fell below $1. And in July, as you saw in previous slides, that's when they filed their bankruptcy, July 2002, and ultimately the stock was delisted. And after emerging from bankruptcy in 2004, the stock was deemed worthless, but it was pretty much worthless throughout those years. As you remember, before the trading was halted, it was below 9 cents a share. Here's just kind of a chart showing the rise and fall. It starts in 1997 and ends in July 2002 when they were ultimately delisted and followed for the world's largest bankruptcy in U.S. history. As you can see, in summer of '99, that's when the stock price is at 64, and then you can see through the 2000 to 2001, the dot-com bubbles burst and a rapid decline, and then all the way down into the junk status listing and ultimately it being worthless. This slide highlights the WorldCom's securities class action litigation. Basically, the investors teamed up, people held stock, and sued the directors, investment banks, and the former auditors, Arthur Andersen. The directors ended up settling for $55 million, and also this was deemed a rare requirement that they had to pay $20.25 million out of their own pockets from the 12 directors that were sued. Also, Arthur Andersen settled out of court for $65 million, although they continued to deny any wrongdoing even after they settled for the $65 million and said that management just misled them the entire time and they didn't have anything to do with it, but they still ponied up the dough of $65 million. And then the investment banks, they got 17 investment banks, and their settlements totaled over $6 billion, 6 with a B, or $6 billion with a B, not 6 with a B. And the next slide is going to be going over the criminal actions, what happened to the former executives and accountants of WorldCom. CEO Bernard Edwards, our former bar bouncer and basketball coach, he got convicted of 9 felonies that were carrying a maximum of 85 years in prison. And he was sentenced to 25 years in prison at the age of 63, so ultimately a life sentence. And as you can see in the picture, he doesn't look too happy about it. Their CFO, Scott Sullivan, if you remember, he got fired when the original $3.8 billion of accounting irregularities were brought forth. He was convicted of conspiracy to commit securities fraud, and submitting a false filing with the SEC. He was sentenced to 5 years in prison. And this photo, I like it a lot. As you can see at the bottom, it says corporate loans to CEOs, $499 million.